Most of us were raised with the same advice. Work hard, stay out of trouble, get a steady job, and everything will work out. But almost nobody sat us down and explained how wealth is actually built. Nobody showed us why some families keep getting ahead without working longer hours. Nobody explained why one generation leaves behind a home, investments, and a thriving business, while another leaves behind debt, financial stress, and the constant pressure just to get by. That's why this conversation matters. If the only way you know how to make money is by trading your time for it, you'll always be working for every dollar. But once you learn how to invest, your money starts working alongside you. That's when everything begins to change. The biggest reason investing feels intimidating is because it's often explained as if you already need to be wealthy to understand it. People throw around terms like ETFs, Roth IRAs, brokerage accounts, diversification, and expense ratios. And if you're just getting started, it can feel like you're looking into a world that wasn't built for you. The truth is, the fundamentals are much simpler than they sound. Investing is simply taking money you have today and using it to buy assets that can grow in value and generate wealth in the future. You're planting seeds now so they can give you more freedom later. Before you start worrying about building an investment portfolio, make sure your financial foundation is solid. It may not be the most exciting part of the process, but it's one of the most important. If every unexpected expense sends you right back into credit card debt, your investments will never have the chance to grow the way they're supposed to. The Consumer Financial Protection Bureau points out that having emergency savings is one of the best ways to protect yourself from financial setbacks. And even a modest emergency fund can help you recover faster without derailing your long-term goals. So ask yourself a few honest questions. Do I have money set aside for emergencies? Am I paying high-interest debt that's draining my income every month? Do I have enough financial breathing room to start investing consistently? If the answer is no, focus on strengthening your foundation first. Pay down expensive debt. Build an emergency fund. Then begin investing. Passive income and long-term investing work much better when your financial life isn't constantly being knocked off balance. One of the biggest mistakes beginners make is thinking investing is supposed to make them rich overnight. That's exactly the mindset that leads people into scams, hype, and bad decisions. It's what convinces people to chase whatever stock is exploding on social media because someone promised it's going to the moon. Real investing doesn't work that way. Real investing is about owning assets that become more valuable over time. That could mean owning shares of successful businesses through the stock market, investing in broad market funds, buying real estate, or contributing to retirement accounts that continue growing for decades. One lesson that has stood the test of time is this: time in the market usually matters far more than trying to perfectly time the market. Investors who stay consistent over many years generally outperform those who constantly jump in and out chasing the perfect moment. The market has a long history of rewarding patience, not panic. If you're just getting started, one of the smartest places to begin is with retirement investing. That could mean contributing to a 401k through your employer or opening a Roth IRA if you're eligible. These accounts offer valuable tax advantages that help your investments grow more efficiently. And if your employer matches part of your 401k contributions, that's one of the closest things you'll ever find to free money. Walking away from that match means leaving part of your compensation on the table. I know what some people are thinking. Retirement feels like it's decades away. You need money today, not 30 years from now. That's completely understandable. But that's also why investing early matters so much. People who build lasting wealth stop focusing only on next month's bills and start making decisions that benefit them 10, 20, or even 30 years into the future. For most beginners, tax-advantaged accounts like a 401k or Roth IRA provide one of the strongest starting points, especially when an employer match is available. After that, keep your investing strategy simple. This is where many people overcomplicate the entire process. You don't need to become an expert stock picker. You don't need to spend every evening reading earnings reports or trying to predict which company will explode next. For most people, one of the easiest and most effective ways to invest is through low-cost index funds or ETFs. Instead of betting everything on one company, you're buying small pieces of hundreds of companies at the same time. That built-in diversification diversification reduces the risk of one bad investment damaging your long-term financial future. Broad market index funds, including funds that track the S&P 500, have become one of the most reliable approaches for beginner investors because they spread risk, keep costs low, and make it much easier to stay invested over the long run. This is especially important when talking about building black wealth. Research from the Brookings Institution has shown that stock ownership has historically made up a much smaller share of wealth growth for black households than it has for white households. Increasing long-term participation in the market is one way families can begin closing that gap over time. Simply put, too many black families still aren't fully participating in one of America's most powerful wealth-building tools: long-term investing in the financial markets. One of the easiest ways to change that is by developing a habit called dollar-cost averaging. The name sounds technical, but the idea couldn't be simpler. You invest the same amount of money on a regular schedule, every paycheck, every week, or every month, no matter what the market is doing. Whether prices are climbing, falling, or making headlines for all the wrong reasons, you keep investing. Why does that matter? Because emotions are one of the biggest enemies of successful investing. People feel confident when the market is soaring, panic when it drops, and spend years waiting for the perfect time to begin. Meanwhile, the people who consistently invest month after month continue building wealth. Steady contributions almost always beat endless hesitation. And over time, the power of compound growth can turn even modest investments into something far more meaningful than most people expect. Now let's talk about something that's especially important in our community. Owning a home absolutely matters. Real estate has helped countless black families build wealth, create stability, and pass something valuable to the next generation. Home ownership remains one of the strongest financial milestones many families will ever achieve. But your house shouldn't be your entire investment strategy. Research from the Federal Reserve has shown that much of the wealth accumulated by black households has been tied up in home equity. That's valuable, but it's also relatively illiquid. In other words, you can own a home that's worth hundreds of thousands of dollars while still struggling to cover unexpected expenses because that wealth isn't easily accessible. So if buying a home makes sense for your situation, do it. But don't stop there. Build an emergency fund. Invest consistently in the stock market. Look for opportunities to own businesses or other income-producing assets. Create multiple ways for your money to grow so you're not relying on a single source of wealth. That's what creates real financial resilience. Another lesson that changes everything is understanding the difference between earning income and owning assets. Plenty of people make good salaries, but never become financially secure. That's because income alone doesn't create wealth. If every dollar you earn immediately goes toward bills and expenses, earning more money won't necessarily change your financial future. Wealth grows when you own assets. Assets are things that either increase in value over time or generate additional income. That can include retirement accounts, index funds, businesses, real estate, and even well-built digital businesses that continue producing income long after the work is done. Research from the Brookings Institution also found that business ownership has played an important role in wealth accumulation for many black households. Owning a business doesn't just create another paycheck. It can create long-term value, provide opportunities for others, and become something that can eventually be passed on to future generations. If you'd like to learn more about that, I covered it in much greater detail in one of my previous videos. Now let's talk about protecting yourself. If someone promises guaranteed returns, effortless money, or overnight wealth, don't get excited. Get cautious. Financial education isn't just about making more money. It's also about protecting yourself from losing it. People who don't understand investing are often the easiest targets for scams, misleading marketing, and flashy promises that never deliver. They're sold fantasies instead of sound financial strategies. That's why learning the basics matters. If something sounds too good to be true, it usually is. If you don't fully understand an investment, don't let anyone pressure you into it. And if the entire sales pitch revolves around urgency, showing off expensive lifestyles, or making you afraid you'll miss out, that's usually a sign to slow down, not speed up. Real wealth rarely looks exciting in the beginning. Most of the time, it looks quiet, disciplined, and almost boring. And that brings us to one of the most important lessons in this entire conversation. Start where you are, but start. You don't need thousands of dollars before you can begin investing. You don't need to master every investing strategy. You don't need the perfect portfolio before taking your first step. You simply need to begin. Maybe that means opening a high-yield savings account. Maybe it's contributing enough to your 401k to receive your full employer match. Maybe it's opening a Roth IRA, buying your first broad market index fund, or setting up an automatic investment of $25 or $50 from every paycheck. None of those decisions will make headlines, but that's how real wealth is built. One quiet, consistent decision at a time.